Hi, I'm Dr. Cheryl Dunn, and I'm here to demonstrate an introductory financial accounting problem in which we're given information about a company's supplies and we're asked to make any adjusting entry that needs to be made with respect to those supplies. So take a minute to look at the problem. Okay, to determine the amount of the adjusting entry that we need, we're going to make a supplies account and kind of analyze it here. So we're going to say this is our supplies asset account. We're also going to go ahead and make an account here for supplies expense. Now, if this company only makes adjusting entries at the end of an accounting period, which is the case for this company, the balance in supplies expense is going to be zero starting out because they would only, as they bought more assets, as they bought more supplies, they would have recorded them in the supplies asset account, not the supplies expense. And then at the end of each accounting period, they'll determine how much supplies expense they had for that period. And so they tell us what the beginning balance in supplies was on January 1st. So the January 1st balance in supplies was $1,200. They then tell us that when they made additional purchases of supplies during the year, those totaled, or during the month I should say, those totaled $3,800. That means the unadjusted balance at January 31st would have been $5,000. They then tell us that somebody went and counted the supplies and put a cost value on them and realized they only have $700 of supplies on hand. What that means is we really want the supplies balance to be reflected, so I'll put this as unadjusted. We want the balance, the adjusted balance, to reflect $700 as the debit balance. Well, in order to get our supplies account from a balance of $5,000 debit down to a balance of $700 debit, that means we're going to need to credit the supplies account by $4,300. The way that's going to happen is we're going to make an adjusting journal entry at the end of January here by debiting supplies expense for $4,300 and crediting supplies the asset for $4,300. Supplies the asset should represent the supplies that are not yet used up. Supplies expense should represent the supplies that are used up. In this case, $4,300 in supplies was used up, $700 remains. So we want the asset balance to reflect $700, and we want the expense balance to reflect $4,300. Another type of question that you could be asked instead of simply what is the adjusting journal entry, or what balance should the supplies account reflect, or what balance should the supplies expense account reflect, you could be asked a question such as, by what amount would the company's assets or income or expenses or something like that be understated or overstated if we failed to make this adjusting journal entry. So if we failed to make this adjusting journal entry, our supplies asset account would have this balance of $5,000. So if they asked us what is true about our assets, if we failed to make this journal entry, we would say that they're overstated by $4,300. In other words, they're too high by $4,300 because we didn't make this entry. If they asked the effect on our net income of failing to make this journal entry, we would say that our income was overstated as well. And that's because our expenses would have been understated. We should have recorded $4,300 in expense that if we failed to make that journal entry, we would not have recorded. And that would mean that we subtracted too low of a number for our expenses from our revenues to get our net income, and that would mean our net income number is therefore too high. Thank you for viewing this demonstration, and I hope you found it helpful.